Today we're going to be discussing equity risk premium. Firstly, what is that?
The equity risk premium is a concept which is used in institutional fund management, and it really is the rate of return that you make over the risk-free rate. Now, the risk-free rate, there's a whole bunch of ways you can slice and dice the risk-free rate, but let's just assume it's the money market rate, at this stage. Some people use, a part and parcel of a bond rate because it's kind of more of a mid-term outlook as far as the cash rate is concerned. But for most investors, the cash rate is available and they can understand it. And really speaking, I mean, the risk premium is really the amount that one should be earning over and above the cash rate over the long term. And I mean, there in South Africa, the number looks in the order of about 9 or 10% per annum over the very long term. But then obviously you have a year like 2008, which seriously put the spanner, put the spanner in the works. When you had actually a negative equity risk premium, when cash rates went up tremendously by 11, we were sitting at 11-12% for the cash rate, and your equity markets at some point was down like minus 20%.
Let's take it a step back. It does exist in South Africa. What about the global markets?
Yes, it does as well. I mean, the equity risk premium obviously is much more compressed internationally than what it is locally. Here. Let me maybe also just say, I mean, the equity risk premium is used by many people to forecast what they believe they could be making out of a market. Now, I think the one big flaw with the equity risk premium is that people try and predict what they can make out of markets over the next 12 months, which is clearly not going to happen. Equity risk premiums work very well when you want to look at forecasting and you want to see what you could potentially make out of an asset class over the very long term. Your big problem, though, is that you're basing much of what you believe today on things that you've learned in the past, and you hope that much of what you've learned in the past will continue to stay true into the future.
Now, you've done some research and you say that if one considers data from 1925 to 2008, equities on average outperform the cash rate by 9.5% per year.
Correct, yes. But then the span in the works is that cash can outperform equities.
Because that's in the short term.
That's in the short term, and if you look at it from a rolling 12-month basis, by as much as about 30%, 30% of the time. And then it can be quite staggering, some of the differences. When your cash rate moves up very significantly, it's not very good for equities, and hence equities always move down, when your cash rate is moving up, and that certainly puts a dampener on people's feelings as far as the equity market is concerned. But equities then, when the cash rate comes back, can scream ahead quite significantly, as we're seeing happening at the moment, even though the markets at this morning and for the last 2 days, has been in negative territory.
Okay. Cobie, how would one use this in terms of forecasting what kind of returns you could get going forward, and in a safe manner, obviously, because there are risks involved?
Yeah, I think the first thing is know that whatever you've learned out of this asset class in the past could potentially not stay true going forward. So you have to actually sit and look at the fundamentals that you deem important and the beliefs that you've built your model around, and you have to question those. So good questions would be, is the South African economy in a stable situation? Is the political situation, is there something on the horizon that I need to be concerned about? Is there something that can change this relationship? Because this relationship, when it changes dramatically. Look at Japan, where equity markets returns have actually been very compressed for very long periods of time. Yes, the cash rate was also obviously compressed, but it's you're not making the margins that you did, say for instance, in the decade leading up to the 90s. I think that's the first big important thing that one has to do, and I mean that's important for private investors as well, because they have to understand the margins in order to understand how much money they want to actually allocate to various asset classes.
What about the interest rate environments and inflation?
Well, South Africa, I think, in any emerging market space for that matter, it's critical to look at inflation and the cash rate because it is so volatile. Inflation in South Africa, as we saw last year, can spike very aggressively, and it's not just last year. You can go back in history and you can see how bad inflation can really spike. As inflation spikes, obviously your cash rate moves in conjunction with your inflation rate, because we're inflation targeting economy, and that obviously cools the equity market considerably and heats it up, when on the way down again. Very different to the Western markets phenomenon, where cash rates move in tandem with inflation, but at far slower rates. 2008 again being an anomaly in that market.
Cobie, do you adopt equity risk premia in terms of investing, and do you use it as a forecasting tool for your investment strategy?
Well, certainly over the long term, yes. So when you're looking at returns over, over 5 and 10 and 15 years, and you want to try and ascertain how much you could be making out of equities relative to, say, bonds and property and other asset classes, equity risk premium is important. Over the short term, not easy to use equity risk premium because of all the ulterior factors that come into play.
So since you are adopting the strategy, what does the long-term view tell us in South Africa? I mean, where are we headed?
Well, it continues to be 9%.
Okay.
Continues to be in the order of about 9 or 10%.
Also taking insurance out on this, I mean, obviously there are consequences to getting it wrong.
Yeah, I mean, I think the global markets, I mean, you're talking about, we're now moving firmly into the institutional space, not in the private investor space, but in the institutional space, there certainly has been moves internationally where people have looked at how they could potentially deal with a collapsing equity risk premium. And some of those are people taking out insurance on their equity investments. There's some life insurance companies which are now thinking about actually offering insurance on your asset management portfolio, for institutions. Other people, such as big asset consultants internationally, looking at doing asset liability modeling for the majority part of a fund, and then for the periphery pieces, looking at alpha generation opportunities, which is trying to get into markets where you could get lots of returns and then banking those returns, and then hopefully putting in derivative cover for a whole fund once markets start collapsing, and again providing insurance, for collapsing equity markets.
Sounds like a risky business.